Good afternoon, ladies and gentlemen. It is Monday, 31st of May, 2021, and it is the last day of autumn, and things are looking pretty chilly for Kogan. I'm going to cover the fundamentals and the technicals of this company and show you guys my thoughts on where I think the company will be in the short term. But do keep in mind, I'm not a financial advisor, and this video should not be taken as financial advice, nor am I recommending you to buy, sell, or do anything with this particular company. Consider it as education and entertainment purposes only. Now, a couple of guys reached out to me. They said they bought Kogan about a couple of months ago, and they're down a good 30% or so. And I asked them, well, why did you buy? And both of them actually said they wanted to buy the dip. And they'll both also happen to be influenced by YouTube as well. People saying that they've bought the stock, that there's value in the stock. And ultimately, they're getting opinions from people who have started trading in the markets from 2020 and don't really know what they're talking about. I'm going to give you guys a better insight into what to look for so you can hopefully make better trading decisions and investing decisions in the future. And you can do your own research, of course. So what I'm going to talk through is the technicals first. Now, I want to dispel this myth of buy low, sell high, or buy the dip, or whatever these things are that you guys hear when you first join the markets. This is not buying the dip. This is not buying the dip, right? It is technically incorrect. Buying the dip is something that should be done on an uptrend, not a downtrend. So let me give you guys a real quick example. Here's Kogan when it was rallying really hard. And of course, because it was an online retailer, there wasn't much of a pullback because all the money was flowing into Kogan. So went from $3.50 all the way to $18. And all of a sudden we see our very first pullback. It's a very small one. So there's a horizontal there. We've got the pivot point here at $15 and it breaks out to the upside. Great. So what we can do is wait for the stock to come back to $18, and that is buying the dip. It is on an uptrend, a structural uptrend. Have a tight stop loss. Ta-da, you're now trading. And what we have here again is another horizontal. So that's potentially another buy the dip situation. Even though the stock has rallied hundreds and hundreds and hundreds of percentage points, it's still technically correct. With, of course, a tight stop loss, because you don't want to break the structure of this trend and momentum. So what we end up with is our very first break of any kind of trend. Here's a trend line. It's a little bit choppy, but what we can clearly see is this news event here, a very strong candle, broken through trend, and it's on high volume, right? You don't need to open up the company announcements to know that wasn't an announcement day, right? There was a huge gap up from 23 down to 21, followed by a huge sell-off. That was 100% some form of news, whether it was company news or a terrible article in the AFR or something like that. But ultimately, that is a clear break of trend. So, buying the dip. Now, there's also a situation where buying the dip here is not that terrible, and that is in anticipation of consolidation. So consolidation is when a stock just goes sideways and it ranges. So we can sort of bounce between levels like this, sideways without going higher or lower, and just bounce within a range. So again, buying here would not be terrible. Buy the dip. Sure, it's not in a structural uptrend, but you could potentially range trade it here. So buy the dip. And then you've got targets. Where's your first target? Here's your first target, which is the previous horizontal. And you got a second target here, which as you can see, it was trending towards. But we clearly got another news cycle here. And you can see by the volumes, huge sell-off. So it didn't end up range trading in that scenario, based purely on fundamentals. So that is buying the dip. That is how the dip is bought. And anything after this structural failure is in my opinion, a real bad thing to do is buy the dip on the way down at any point on a downtrend. And it's a downtrend because, first of all, there is no longer an uptrending structure of any sort. That it's clearly broken. We now have higher lows, so we can clearly see a trend line forming, a negative bearish trend. And we also have trend lines here as well. So that is why buying the dip is terrible on a reversal, because where can you sell into it, right? So here's my plan for buying in the future for Kogan if I was to enter the stock or look to enter the stock. First things first is shorter term timeframes, right? So we can see here that there clearly is a channel of sorts being forming, and what we have here now is a short-term time frame, a short-term channel. We can quite clearly see it's ranging in this channel. It's hitting the peak and the trough, and ideally breaking that would be the first sign of a reversal. All right. Some of you might be thinking, oh, why didn't I just buy when it comes down to this horizontal here at $8.72? Well, the short answer there is, well, you're doing the exact same thing that's considered technically incorrect. And that is buying the dip on a downtrend. It's like, okay, if you buy here and the stock keeps dropping to this bottom trend line here, you're just losing like 5% for nothing, right? There's no plan. There's no structure. It's just a downwards trend. So what we have, what we're looking for, what I'm looking for to clarify, is perhaps maybe a bit of a pullback and then a test of this trend line. And ultimately, the first thing I want to see is a break of this trend line. And secondly, is a break of this horizontal at 1064. That would confirm two things. One, we've got a break of downtrend. Second, we're creating a higher high, because that will no longer be the high. It'll pull back and rally. And then suddenly, we've now got an uptrend, right? You're going to have two data points. You're going to have one data point here, let me just clear this up. We'll have data point here and here. And the idea is to have a data point up here and up here, or something to that effect. So that way we can see, we can draw some trend lines and define this reversal. And then you're probably wondering, well, where's the entry? Well, the entry is at one of two places. And that's either going to be when it breaks this trend and comes back down. That would be my entry, because I'll be buying the retest of a potential reversal. Or let's say this stock goes down and then breaks, I will have a trend line. So that way, on the pullback, I'll have an opportunity at, say, in this example, at $9.80 to enter the position, minimize risk, keep the stop loss really tight, and then anticipate the break to the upside, and then re-enter again as it retests on the pullback. So buy the dip. So that's the plan. You might be wondering, well, this is all crystal balling, and well, yeah, the structure hasn't been defined yet. What I'm doing is I'm planning what to look for, and the very first thing to look for is the break of this horizontal and the break of this bear trend. Those are the two things that I consider absolutely necessary in the current situation in order to convince me to buy this stock. Otherwise, I'm picking the bottom like an idiot and losing money for no reason, because it's still in a downtrend. So if this chart happens to develop and it's still downtrends and it does something else, and we can come back to this in a month or two or three when the chart has developed and say, right, what are we looking for? So that's the plan. That's ultimately what I'm looking for. At the moment, I see zero signs of a long entry until those conditions that I've just discussed are met. And that's just my opinion on the technicals. So let's take a look at the fundamentals. We have a stock, and I'll talk through what this chart is. And we have the half-year reports, right? These are all half-year increments. And these are derived from the Appendix 4D, 4E, and or 4C, right? Those are the quarterly, half-year, and full-year reports. So what we have here is half-year chunks, and the blue represents revenue. The gray is costs of goods sold, and the gross profit. So all that is revenue minus costs of goods sold is the gross profit. And then what we have is this lilac line here, this trend line, and what that is the margin. So we have, for example, we have 40 million in gross profit divided by the revenues of 203 million, and that gives us just under 20%. And that's what this trend line represents, is the gross margin. You can see it's on a nice uptrend. Revenues are on a nice uptrend. Cost of goods sold isn't really essential to this chart, but we can see as a result, the gross profit is also on a slight incline for pretty much most of the time. And then we have total equity, which I like to summarize equity as, if you sold everything in the business and paid off all the debts, that's how much money would be left over. That's kind of the simplified version of equity. So we have in 2020 here, and the mid 2020 and the end of 2020 is a big spike, or a rising spike in revenues, and a big spike in revenues on the second half. And that's obviously due to lockdown. And you can see costs of goods sold going up, but ultimately the profit's gone up as well. And that's what matters. Profit and equity is rising. Now, here are the estimates that I've obtained from Ticker. And we have estimates for next month that the numbers will be about 368.5 million in revenues. So of course, we've now got a decrease in revenues, and then a further anticipated decrease to 219 mil, which effectively is the same amount of revenue as the end of 2019 and the start of 2020. So from a chart perspective, let's take a look at that. Let me just clear all the lines here. Now here is basically those financial numbers pre-COVID when things were going pretty steady. Had a market capitalization of about $700 million. Let me just bring that up. $710 million in market capitalization. Reached a peak of about $2 billion on this financial report here at 414 million, right? So what we have is an uptrend in numbers. We have an increase from pre-COVID numbers of about 2.5x, right? From 700 mil to 2.1 mil, right? 2.5, 3x in share price and market capitalization. But we only have less than double in revenue increase. So you can kind of see where that doesn't really make sense, right? The numbers just aren't high enough to sustain that momentum and growth. So what we have is numbers from or anticipated numbers towards the end of the year to be about the same as end of 2019. So let's have a look at what that looks like. So end of 2019 here at about $7.70. Now, there is one thing worth noting, and it's not just by default. It's not like you just go, okay, so this is clearly going to $7.70 because it's got the same revenue numbers. It's not that straightforward. What we're going to look at is the equity would also be hopefully in a good position, right? Equity is rising. Margins are also increasing. So keep in mind, these guys went from about 16% margin to now 27% margin. So in the future, hopefully the margins will be sustained. So it's not like the business is going back to $7.70 in terms of value. It may very well do that on the charts. But in terms of a fundamental perspective, if it reaches that $7.70 level, I would consider that oversold, assuming these estimate numbers end up true. So the margins I expect would stay the same or very close to these highs at around 27. And margins do sit around 30 to 35 for your average retailer. So 27 is pretty good for Kogan as an online only store. And yeah, so that's kind of my view on things from a fundamental perspective. I expect it to come down. I expect any retest of these levels at $7.50, $7.70 to start becoming a good value proposition from a fundamental perspective, provided the numbers are accurate. Let's keep in mind also there is short-term pain. We have this announcement that came out on the 21st of May, so 10 days ago. They had issues with demurrage. So they mentioned that they experienced significant abnormal costs over the last 5 months. Now, for those of you who don't know, demurrage is where you're unloading from a dock or a ship of some sort, and you don't get the product off fast enough. So you're wasting the ship's time. You've been given an allocated time, and you're incurring fees or a fine as a result of not being able to unload in time. So I don't know what imposed significant abnormal costs is. Is that in the millions? Is that in the tens of millions? So I really want to find out what that looks like. And I guess we'll find out next month when the financials come out, but that will be key. If it's like $10 million or something, like I honestly have no idea what demurrage costs. I haven't the slightest clue. So the key word here is significant abnormal costs. So to me, it sounds like it'll be millions or tens of millions or something that'll dig in hard into their margins and profitability. And it's worth keeping that in mind. So there is some short-term pain that exists there. I also want to note that there is an issue in terms of inventory levels as well. So of course, they're rising as a business, then their inventory has to increase a little bit as well. But they are looking at normalizing it, and really, you know what, it's going to cost them money to store products, especially when they're storing like $120 million worth instead of like $30 to $40 million worth, which is what they were doing before. So there's a pretty big increase in inventory costs and increase in product. So there is some short-term pain to come. So it wouldn't surprise me to see this stock at pre-COVID levels at around 770. So from a fundamental perspective, I would consider a scale-in position from around 770, considering the fundamentals don't change significantly from what I've just discussed now. So 770, and then from a technical perspective, perhaps there'd also be a level at $6. And then this is from an investing perspective, by the way, not from like a trading one. From a trading one, short term, it'll be an absolutely horrific thing to do to, again, as I discussed, is to buy something on a monstrous downtrend. But for investors, right, you can't pick the bottom. For swing traders, break of trend to the upside, that's easy to do. That's easy to spot, and it's easy to ride that momentum. But from an investing perspective, purely an investing perspective, without taking consideration of fundamentals, without taking consideration of technicals whatsoever, from a pure financial situation, I would look at a small entry, 770, and a much larger entry at around $6, just above $6. If it gets there. If it doesn't, then so be it. So you've got now my technical targets, and really, based on the fundamentals, what I just saw, what I just read out, I don't see this breaking to the upside to $14 or so. It may do so technically on a short-term basis. So from a very, like maybe 2 to 3 month basis, it could be a good swing trade to the upside to retest maybe this trend line. But fundamentally, I simply cannot see this breaking to the upside unless something significantly changes with the business. And I mean significantly changes. So perhaps a break, perhaps a retest of this horizontal would be more likely based on what we've seen. So really 1020 perhaps to 1169, and really if momentum kicks in, then perhaps somewhere on this trend line, and then a rejection, and then all the way back down. I can't see this combining fundamentals and technicals together. I just can't see this in the short term holding value. If it breaks to an uptrend, I can't see it holding value. What I can see is a continuous downtrend, a short-term bounce off this level here at 770, and ultimately, by the end of the year, coming back down to this $6 level. And there, I would start considering a value proposition for a long-term 3 to 4 year hold, and seeing how the company progresses, of course, assuming revenues are able to swing back up, of course, and keeping an eye on the stock there. But that really is my general perspective, and I hope that makes sense to you guys. I know it might sound a little convoluted mixing technicals and fundamentals together, but I do hope it comes off clear that from a technical perspective, it really is about the short-term trading targets, short-term to mid-term trading targets. We're looking for less than 6 months for sure, provided a break of trend happens. And yeah, for long-term, fundamentally, anywhere under pre-COVID levels would be sound, provided nothing really changes that significantly. And then, of course, technicals for me is the short-term to mid-term swing trading. Fundamentals is for the long-term investing. So I hope that clarifies for both people who are looking for mid and short-term as well as long-term. Otherwise, guys, I'll see you next time.